Hello, everyone. Welcome to the May 2nd edition of the Scientific Governance and Risk Meeting with MakerDAO. We have a surprisingly relaxed, I'm predicting, call today because I think we've reached a point in the governance process and our manipulating of the risk parameters where it might be time to have sort of a more of a free-flowing chat in this call, more of a focus on Q&A and less on interesting and or dramatic recent events. So I'm not going to do much speechifying today. I will do the same reminder I do every single time. I will never stop and nobody can make me stop. We are very, very interested in getting feedback from the people in this call. So lots of smart people, lots of strong opinions, lots of analysis in people's back pockets. We want to see as much of that as possible. So even if we're speechifying and rambling and looking at graphs, if you come up with questions or you have comments or there's things that you want to say, please do not be shy. We want to hear from everybody. So either type it in the chat at the side if you don't have access to a microphone, and somebody will hopefully come along and read out that question for you. If they don't, type it again because we might have missed it. Things can get hectic in here. If you have access to a microphone, jump on it and start talking. Don't wait for an opening if you don't want to. Although it would be nice to let people finish their sentences before you jump in with a rebuttal. We're also super keen about continuing this discussion. This is a very tiny window of opportunity for people to engage with the governance process. It's not designed to be the place where decisions are made or governance happens. This is where we talk about major themes, come up with plans, and debate them in other areas. I'm posting a link in the chat right now. This is a link to our subreddit, the MakerGov subreddit. There's a post there that's right now is advertising the meeting. After the meeting's over, that turns into the discussion thread for the meeting. So if you have a question, I would also dearly love it if you would paste those questions into the subreddit, into that thread, because that lives on for a week or more, and it gives plenty of opportunity for people to respond and provide input. The chat here, you only have about 50 minutes to get somebody's interest in. So Reddit is better. I think that's going to be it. I always forget something, and then I halfway remember, and then I cut Stephen off, but maybe I won't do it this time. So Stephen, I'm going to hand this off to you for your thoughts of the week, and then we'll talk to risk, and then I'll talk a bit about the poll. So Stephen, it's all yours.
Okay. Thank you very much, Rich. Firstly, hello again, everyone, and welcome. I really appreciate you taking your time and obviously committing resources towards exploring and facing these challenges of scientific governance as a community. It's quite impressive to see the number of folks that turn out week after week and take on these challenges for the system as a whole. But the one thing that I'd like to bring up, and in light of recent events, is just to recap quickly on some of the strengths and weaknesses of a decentralized stablecoin. And I'm going to start off with what is always seen as an apparent weakness, and that is, a decentralized stablecoin seems to be at the foibles of the underlying DeFi environment, the underlying ecosystem, and is always representative of what that system looks like. So right now with DAI sitting below $1, there's this constant idea that it needs to go back to its peg of $1. But the reason we see it at its discount is because of the underlying risks that are so clear to everybody. Everybody understands where the supply is coming from. Everyone has the ability to see and analyze where the supply is going to. The stakeholders to the system are transparent. The very idea of a decentralized stablecoin being transparent is, firstly, its weakness because all the risks are exposed, but at the same time, that's where its strength is. There's nothing opaque. There's nothing left outside of the user's view. Everybody can see very clearly what is involved in the system, what the supply is of the system, and the effects of it. And this is really where we can get to a forum like this and discuss clearly the underlying dynamics behind those risks. And the reason we can actually talk about those dynamics is because the risks are very clear. And for me, at the end of the day, it's a weakness, but at the same time, a very important strength of a decentralized stablecoin, and especially of DAI. So, you know, on that point, looking at some of the wins we've had, there's obviously a lot of debate around the use of certain levers in trying to restore the peg. To that point, the idea is also, what does it mean to restore the peg? What do successes look like? We've used the stability fee, and to my mind, and I'm just a single data point in this, I feel that progress has been made. We are, you know, getting to a point. Now, the argument could be made that maybe it wasn't the stability fee, maybe it's the onset of a range-bound ETH collateral that is contributing towards the restoration. Well, I don't know. The point being is that this is the forum to actually discuss it. The next thing is also to consider the fact of, you know, the peg being stable. A lot of folks have asked me, you know, do you think the peg is broken? And I think, well, no, it's not. It actually is kind of stable. It's just not at the value that we intended. So, you know, I don't mean to make it farcical, but the idea is that the stability of the value is there. It's just generally at a discount. And that discount is more reflective of the regime that we're in. And what I foresee is that as soon as multi-collateral DAI comes out, and as soon as we start you know, getting the right kind of collateral into that portfolio, and then the next caveat is that the portfolio becomes, it gets to a certain critical mass, we will find the diversification effect working on our behalf, making the portfolio, the collateral portfolio stable, and that stability begins transferred into the price of DAI, and also, and interestingly enough, the volatility of the stability fee as well. And with the hope that the stability fee comes down and, you know, represents accordingly a more competitive rate. So that's my little intro for the week. But once again, I just want to remind everyone that the three themes we try and cover in this call are the, you know, the demand and supply imbalance, the collateral types, the portfolio, and the parameters and adjustments to the collateral types in the portfolio, and then obviously exogenous risks that we need to consider as well. Again, keep in mind that decentralized scientific governance ultimately is considered and facilitated by the foundation in SAWA in order to help MKR governance make decisions. That is really important. And at the same time, this is a continuous function, so please be involved as much as possible. So that's me. On the back of that, let me kick back over to Rich.
All right, thank you, Stephen. That was a great reminder. I'm going to try and keep my segment as small or as lightweight as possible today, so I'm not going to get into some big speeches. I am going to do something that I find is useful in a quickly evolving space that like the one that we're in right now, and that is to point out some of the obvious things that we've been discovering in the last few calls. Crypto space. 1 year in crypto is 5 years in the normal world. We're constantly looking ahead and trying to predict what the world will look like, and we're always wrong. And we're more often looking 6 months back and trying to figure out what happened. And that's fine, I think. But it's important that everybody, or the community as a whole, sort of gathers around these paradigms that are reflective about what actually did happen. And I think that we're kind of in that process right now at MakerDAO. Or at least I am. Maybe I'm just slower on the uptake than a lot of people in this room. But I want to reiterate some of the things that we're beginning to discover. We assumed these things were true in the past. I think that now we're reaching a stage where they're unarguably the case. And one of those things is shaped or sort of falls into this bucket of product market fit. That's an often used term in this space. And I think that one of the things that we've discovered over the course of the last year since we launched is that MakerDAO has found a product market fit, found a great one. The market loves us. The interesting thing is that in these situations, the market determines what that fit is, that we don't determine what the fit is. And over the course of the last year, we've become certain, I'm using the royal we here, and I'm obviously open to being debated on this topic, but CDPs are a tool for people that are seeking leverage. It's as simple as that. We have other use cases in play, but the engine is driven by people that are looking for leverage, and that means that the market has told us that that's what the fit is, and that fit places us into a different world than one that we might have predicted at the outset of just simply unlocking liquidity and opening up the door to a wide range of options for people to do. The system has to follow the behavior of its users, and that behavior is leverage. And so we're in a world where the fees associated to incentivize or disincentivize that behavior need to mimic the fees that are already very well understood in the space, our space in the traditional finance world. Of what kind of premium you attach to that risk that people are willing to take on. And I think that sort of brings the stability fee process that we're in right now, searching for that equilibrium, into crystal clarity. It's just simply the world we're living in. So that's my 5 minutes spent on pointing out the blindingly obvious, but I think there's some utility in it. I want to talk very quickly about the results of the poll, because I tend to forget to do that, and that's the whole reason we're here, or one of the reasons we're here. But we're seeing this interesting trend over the course of the last two governance polls, where there's no longer a clear rush to one extreme or the other. People aren't overwhelmingly voting for the 4% option. We're seeing the rise of a moderate faction, possibly, or a trend in the community. So last week, we saw, or the week before, we saw, sorry, was it last week? It was the week before. Okay. We saw this sort of a deviation or a neck and neck race between 2% and 3%. And we saw the same thing again this week, which I think is a very interesting trend. So we had a photo finish between the 2% and 3% raise options. 3% won out, 32K staked, as opposed to 27K staked at 2%. So on Friday, we'll have an executive vote for a 3% raise to the stability fee, bringing us to what I believe is 19.5. That's where I'm going to leave it, actually. I will spare everyone the rest of my ramblings for today. So, Cyrus, I'm going to hand this off to you to talk about risk.
Okay, thanks, Rich. So I think today, after we hear from Vishesh with the state of the peg, I think we're just going to open it up to just general conversation. I think we have a few topics lined up that could be interesting to discuss, such as how to determine when the peg has been fixed, what kind of indicators are we looking for. Seems like right now we're at least headed in the right direction, so it might be a good time to start thinking about these kinds of things. And I think we might hear from Matthew as well with some of his concerns, thoughts on that as well. But yeah, in general, I think it's just going to be somewhat of an open-ended conversation. And yeah, so Vishesh, if you're ready.
Yeah, let me share my screen here. So I had a couple, oh, thanks, David. So I had a couple of things to show this week. I did kind of want to add a little bit of context this time. So I think there's been a lot of discussion about, like, what are the use cases for CDPs? What are the right use cases for CDPs? And how is that affecting the DAI price? I mean, by and large, my view, yes, like leverage is an extremely important use case. I think there's like a spectrum effectively of sort of bullishness and bearishness, in the sense of primarily on ETH price right now, because that's the big collateral type. But essentially, as people are more bullish, they're seeking leverage, and so they're drawing more debt out of CDPs. And then when people are more bearish, they would potentially, you know, buy up DAI as a shelter, or you know, just really look to de-lever their positions as they get less bullish on ETH. And so I think like that underlying bullish bearishness behavior is what's driving a lot of what's going on. And I think we'll try to add more insights kind of week over week to better illuminate how that's going, so we can kind of fine tune what needs to happen or doesn't need to happen with the stability fee. on kind of a week-over-week cadence. But so basically the reason I bring that up is because in the last week or so, what we've really seen is the DAI prices actually started to stabilize a little bit. I know there's been some kind of natural roller coaster behavior up and down in between, and I think Lev's chart in terms of the dot plot shows this a little bit better. But essentially, even though on average the price has actually held relatively steady in the sort of 97 to 98 range over the past couple of weeks, there were a few spikes, stuff that was going on with Tether, things like that. But those tend to stabilize, I think. And so what we've really seen is that as we've increased the stability fee over the past few weeks, I think the DAI price has actually stabilized a bit. There has been a lot going on, like I said, with ETH and with Tether. So as always, take everything with a grain of salt. But I think that is a positive indicator that what we're doing actually has an impact. So this is still the relationship between DAI and ETH price holds, at least visually, fairly strong. So I think this kind of speaks to the importance again of just the degree of bullish and bearish sentiment on ETH being a big driver for the sort of fluctuations in DAI price. Although it is a good sign that even though this did kind of ramp up a bit and ramp back down, the magnitude, I think, of those fluctuations and their impact on DAI price has gone down. And I think that's what we'll tend to see as DAI supply decreases, particularly as oversupply decreases. I think just the degree of variation, and as we increase the stability fee, which I'll talk about in a second, I think we'll see the degree of fluctuation in DAI price based on what's going on with ETH price decrease. And so it may not necessarily come all the way back up to 1, but I think a little bit more stability, even if it is a little bit below $1 peg, is a positive indicator. So in terms of what's been going on with DAI supply, it has been coming down pretty consistently over the past few weeks. We've seen some big kind of wipes and burns, but not necessarily a bunch of big new CDP positions that have been taken out. So I think this is just, again, an indicator that what we're doing has a legitimate impact on the DAI supply. So transaction volume, I'll skip over for a second. In terms of what's been going on with Compound, I think all quiet on the Western front there. Things have been relatively stable, even with the increase in the stability fee on the 28th. So there's like a slight increase, which is to be expected, but it is interesting that the Maker stability fee has been able to keep its lead on the Compound rate. I think and then if we go to volume for a sec, that is also held relatively stable. So I think, again, what this says is that places like Compound are falling into a more natural sort of secondary lending position in relation to Maker, which I think has not been the case in the past. In the past, there's been either some arbitrage opportunity or people pulling DAI out just to lend it. But now I think we're starting to see more of the use case of people will actually look to like Compound or Dharma or things like that as an alternative to drawing DAI from CDPs, as opposed to in the past where it's been super cheap to draw from CDPs. So I think this is a good, healthy relationship between Maker and secondary lending platforms. I know there's a lot of discussion that's been going on in terms of how much do these secondary lending platforms contribute to demand versus just kind of being an alternative pathway, but still having the same ultimate effect on supply and demand for DAI. And I'm sure plenty of people will have extensive discussion about that. In terms of just numerically what's been going on, I do kind of want to skip over a little bit to something else that I've been putting together. Apologies, it's not in the website just yet, but I had kind of pulled the data and gotten a chance to graph it just before the call. So essentially, two of the things that I was looking at was one, the collateralization ratio. So what's interesting is collateralization ratio, along with the decrease in DAI supply, has been coming down recently. I think what this means is that what we've been doing with the stability fee has reduced the overall profitability of going hyper levered. And so what we've seen is people actually kind of delevering their positions a little bit. I think we've also seen a little bit more stability in what's been going on with ETH price. And so people have kind of, both from less of a desire for levering up, although that's very hard to measure from a data perspective in terms of how much people are actually levering up. What you can measure is kind of the theoretical leverage based on collateralization ratios. And I'll show that in just a second. But in terms of the actual amount of leverage that people are getting, it's hard to track. But my suspicion is this is a result of a decreased appetite for leverage. And I will show the calculations on that in just a second. The other thing was I had started to look at age. So I brought this up a few times. I think the circulation of debt in the system is an important metric because large quantities of unpaid fees are a systemic risk, I believe. And so one of the topics that I think is worthy of bringing up on a call like this is kind of what's going to happen in the single collateral to multi-collateral shutdown. So there's, from my understanding, the current state is that unpaid fees would not they would essentially be forgiven on shutdown and switch over from SCD to MCD. Now, right now, the governance process has the optionality of instituting a tax or a penalty on any outstanding debt and fees at the time of the switchover. And I think it's going to be really important for us to kind of lock that down, because in the absence of that, the incentives are just kind of screwy, where people could, sit with a bunch of outstanding debt and not have to worry about it. And I think there was, some tweet about some large holders that were kind of thinking this way. And so I just want to make sure that that's a topic that this group kind of nails down soon. And there was some chat on the Rocket chat about this as well.
Sorry, so you're saying that potentially as we transition to multi-collateral DAI, there currently is an expectation from some CDP holders that their debt will be forgiven. Do we have confirmation of that? Because obviously, if that's true, then we could explain why certain CDP holders weren't shutting their CDPs when we were increasing the stability fees.
Yeah, I don't think, I think that that's not the right framing, because there is a tax, as Vishesh mentioned, to penalize those CDPs, and two, I just don't think that.
Are there details on that tax somewhere? So I'm totally new to this. I had no idea this was a discussion really until very recently. So
yeah, I believe there are details somewhere. I don't have them off. And
yeah, I wanted to clarify my comment. I don't want to sort of create any unnecessary doubt or uncertainty, but essentially there is like a specification for a tax that exists in the governance framework as I understand it. I just was bringing up, I think it's important to lock that down, figure out what that's going to be, and make sure that gets implemented. I don't think it's a super likely scenario or rational behavior that people are expecting that a tax does not get implemented, but just, you never know what people are thinking, and it's very hard to quantify that. So I think just from a good housekeeping and communication perspective, it would probably be a good idea to lock those details down and communicate them broadly.
Got it. That makes sense.
Yeah, I can speak to that very briefly. So these are, I spoke earlier about the risks of predicting what the crypto space looks like in the future, and that applies equally to what the technical implementation of the Maker system looks like 6 months from now. I think that it would be extremely risky to count on this as some kind of secret backdoor to avoid fees when we switch over to the new system. There will be additional details coming up, but people are still writing contracts at this point, so we don't have anything we can publish right now. Okay.
Sorry, yeah, I'll just wrap up then. I'm sure people want to discuss some of these topics. So just to that point, I was looking at how old the debt is and how much it's been circulating through the system. I'm pleased to report that since the sort of increases, I would say significantly starting in March, you did kind of see, but a little bit earlier on in February as well, you did start to see the trend kind of reversing itself. So this is just the shorter snapshot of February to now. But if I expanded the scale, you would essentially see that the age of the debt here has been increasing over time. But since around February, March, that trend has kind of started to reverse itself, where the open debt is not as old anymore. And what we've seen is the age of the debt that is being bitten or voluntarily closed out has been increasing. So what that means is effectively there is less old debt outstanding, and people have been more willing to pay back old debt recently. And so to me, that's a positive indicator, because I have been sort of interested in kind of a bunch of stale outstanding debt being a risk for the system. And so I think it's a really good positive indicator that there's been more circulation recently, given these stability fee increases. Now, the last thing I just wanted to briefly mention, and I'm happy to share any of this stuff for anyone to poke holes at later. Essentially, I did some rough calculations on kind of how bullish you have to be on ETH for it to be profitable, for you to just go max levered or levered up to a recent, like whatever the latest collateralization ratio was. So essentially, if people are familiar with the leverage calculation, I'll skip over this part. But essentially, given a certain collateralization ratio, there's a maximum threshold of leverage you can reach. And the theoretical maximum leverage point is 300%. Now, given a leverage amount, there's effectively a profitability calculation of based on an expected increase in ETH price over the period of, let's say, 1 year, given the stability fee, given like a 6% cost of capital, how profitable, like would it be profitable or not for me to just lever up on ETH and hold it? And so essentially the point was, when I looked into this, like I saw that you don't have to be that bullish on ETH for it to be profitable, for you to just go levered up, ignore the stability fees, and hold on for dear life. And so I think what this means is, like, based on how high the stability fee is, not actually that high, is effectively, I think, the point. So based on what the stability fee has been in the past in particular, but even still now, I think there's an equilibrium that exists, and the fulcrum point is a function of the stability fee. And so the equilibrium has been sitting pretty heavily in kind of the bull category, where you don't have to be that bullish for it to be profitable. And so as we continue to increase the stability fee, we're just sort of moving that fulcrum point of the kind of bull bear equilibrium. And I think it has an impact we've seen clearly on supply, but then ultimately an impact on DAI price, because effectively as ETH price fluctuates, where that equilibrium point sits changes what the DAI price is. And so happy to sort of later go into any details, answer questions, share data, have people poke holes. I just wanted to kind of share this as the topics that I've been looking into and trying to start to measure.
No, but that quick question for you, that's across all CDPs, but do you have any metrics that are like CDPs that have an outstanding debt of, let's say, greater than $100,000, folks that are actually actively levering, not folks that have, $5 outstanding in a CDP? Because that's going to screw with the metrics if you include, 500 folks that actually don't have really any money and don't care if it gets bitten.
So in terms of the theoretical profitability calculation, or which metric are you referring to, filtering down to large CDPs?
No, I mean, just basically the sensitivity of every time we're increasing the stability fee, how much DAI is being reduced. Because, I mean, kind of to your point, like, it's the folks that have lots and lots of DAI outstanding, they're using it as your more than likely related to leverage transactions. So the question I'm trying to get at is the ones that have the many, let's say, greater than $100,000 are ones that are probably active in that type of space. Folks that have a CDP of less, it helps us bring granularity and focus into folks that to identify the sensitivity to where a given CDP owner decides this is just too expensive, I need to back down. Where some folks, if you have a blended across all of them, the guys who've got a $2 DAI outstanding, at some point they just don't even care if it gets bitten.
Yeah, I agree with that we will see different behaviors for larger CDPs. And I think that the larger CDPs tend to drive the overall behaviors of the system. So I completely agree with kind of in principle, focusing on large CDPs where possible and really kind of segmenting things so we can see what they're doing differently. In terms of the stats that I've shown here, like for example, the collateralization ratio is sort of total debt weighted across the whole system, but I could look at the collateralization ratios of the larger CDPs and then calculate the max leverage for those CDPs. And then what we can essentially assume, and I think it's not unreasonable, is that people who are taking out big CDP positions are probably pursuing close to what their maximum leverage is, given their actual collateralization ratios. And so, like, I think it is not unreasonable to say, hey, whatever the max leverage is for those large CDPs is probably close to the leverage that they're actually pursuing. And so we could look at that as an update to this, is kind of segmented out for those larger CDPs. The other point was on the age of the debt. That is, so I initially did the calculation based on DAI days. So essentially based on size of debt and age of debt, and then adjusting, dividing by the total supply. So that particular metric is definitely weighted towards what, like, it would be more representative of sort of the top 10% or 20% of CDPs, which, as Primoz has shown, constitute a large portion of the overall debt. So certain metrics like that are debt weighted, and I think are probably more representative of those larger CDPs. But I totally agree with the principle of segmenting some of these metrics where possible to those larger CDPs.
Can I ask another question on the age of the debt calculation?
Yes.
So there were two lines in there, if I recall. One was current debt, the age of current debt outstanding in the system, and the other one was closed debt. Is that right?
Yes.
Can we look at the graphs while we're talking about it? Okay, thanks.
That's helpful. Thank you.
Yeah. So essentially, there's the two lines. I just wanted to break out CDPs, or in particular debt tranches, because I had to do this at the individual kind of draw level. So DAI that is outstanding, how old is that DAI, is the blue line. The red line is essentially DAI that has been bitten or wiped, that was created. So essentially for a particular date, essentially DAI that was created before that date and was closed by that date.
This is really interesting. So let me ask you this then. On the red line, so if you're doing it at the draw level, let's say I do 3 draws, right? Draw 100 DAI, 100 DAI, 100 DAI, then I pay back 150. Are you doing LIFO or LIFO? So are you going back to that first draw and wiping that? Or are you going to the last draw that I did and wiping that and then some of the second draw that I did?
So, and this is how I understand, like, in practice, the system would be calculating fees and things like that, for example. I am effectively clearing out the older debt first. So it's first in, first out.
And that's how the system is calculating fees. So that's how you're justifying that.
That is my understanding, yes.
Okay, perfect. Thank you.
Vishesh, I wanted to comment on your this kind of cost-benefit analysis of CDP with respect to interest rate. There's an interesting thing that that you could do there. For example, you might be familiar with in modern portfolio theory, where you've got this parabola of an investable universe, and you compute the efficient frontier, and then you have this tangency line, which is called the tangency portfolio or something, and then if you remember that you pick a portfolio on the tangency line using some utility function, which basically says how risk averse the investor is. And then there's also another way of deriving similar results, but I think in a more principled way, if you go through ergodic theory and try to maximize time average growth rates of a geometric Brownian motion as a stochastic process. But the point is that this calculation gives you another perspective of doing this cost benefit analysis that is more risk sensitive. That's not just looking at expected return, and in fact, it lets you derive an optimal amount of leverage for without any assumption on an investor's risk appetite. And if you apply this analysis with here, this would be like an alternative way of constructing this this table. So maybe if you want to talk afterwards about calculating something like that, I think it would be interesting. I had the thought of doing this a couple of months ago, but I never followed through with it.
I would love to have that discussion. I was actually kind of manually just doing that a little bit, playing around with these numbers to see what is the max leverage given, first I did just theoretical max leverage. Then I decided, well, that's not really realistic because not everyone's going right, to they're not moving the needle right to the red line. And so based on what the actual collateralization ratio is, what is that theoretical max leverage? And then from there, kind of varying it out and just changing the numbers to see, what would the yields be at different expectations. And as you're kind of alluding to, which I'm familiar with, we did do a little bit of portfolio optimization work before. Effectively, max leverage is not necessarily max yield. And so there's a whole science, as you're mentioning, to sort of maximizing yield at either different leverage points or sort of based on kind of expected value analysis of different price point movements over time. Plus, like the other thing to factor in here is risk of liquidation. So just given actual volatility of ETH price, what's the chance that you get knocked out of the game before you can realize your yield is another confounding variable.
Yep. So yeah. Well, in short, what I'm suggesting is like how to do this kind of analysis, but in a risk conscious way, and that's where it might turn out that you don't want to get max leverage that doesn't actually maximize your expected return. But let's talk about that later.
Yeah, my only concern there would be how would you observe those risk preferences from the users of the system, and then what their implied expectations about future volatility are. It's a little bit easier to reason about potential return versus the stability fee because they're just static numbers that you can plug into Excel. But here it might be a little bit trickier because one, you have to think about what your risk preferences are, and you can't observe those from real market prices. You can't synthesize a portfolio. And then secondly, what the volatility expectations are, or the sigma.
So Alex, I agree with that, but I was also having an interesting discussion with Primosh this week. Like some of you could potentially approximate some of kind of that bullish sentiment, so to speak, based on sort of derivative rates on other platforms. Like, what are the costs for leverage long positions, and how much are people taking them on like Bitfinex or something like that? There are ways that you could potentially approximate it. I would be really interested in kind of hearing if people have other kind of ideas of ways we could measure that. But that was kind of one thing that Primosh had suggested.
Well, it sounds to me like we could get an estimate of it just simply by looking at the because what we're ultimately trying to figure out is the sensitivity to the stability fee. But what we can use the current snapshot of the system as a way of reverse engineering the risk the risk appetite of the aggregate CDP user.
Yeah, I think that's a good idea. We should probably take this offline before people start dropping like flies from this call.
Okay.
It was super valuable though. So if you're ever tempted to get this nerdy again in the future, please do. That was excellent. Thank you. Cyrus, did you want to pick it back up?
Sure. All right. So I guess moving on, if there's, I mean, this is really kind of open to the floor, but if nobody wants to jump in, one thing I thought we could discuss was kind of gauging when the peg has been fixed. Some indicators that I'm looking at are, one is healthy two-way flow around $1, so trading back and forth. Basically, not just looking at how much volume is cleared at $1 by itself, but making sure that kind of the supply overhang is taken care of, and we see some good back and forth between 99 and 101 or some tighter spread. Another is inventory levels from various market makers, and I think it might be a good time to start ramping up those discussions again, and maybe having certain market makers talk about maybe just, instead of absolute numbers, maybe relative declines or percentage declines in their inventories, maybe what kind of targets or how much supply they're targeting for their books. Another indication could be time frame, the amount of time we're comfortable observing DAI being traded at $1 before we're satisfied that it's kind of found the right spot. Having it trade there for 1 day is much different than having it be there for a week or 2 weeks or a month. So these are some of the ideas we've been brainstorming internally, but would love to hear thoughts from the community as well.
Matteo came up with an interesting question, and it's interesting to me because I don't know what it means. Matteo, do you have access to a mic, or would you like me to read that out for you? I will read it out unless you interrupt me. So Matteo asks, potentially we could approximate with options analysis, no question mark, in order to quantify bullishness. So I don't know what options analysis is. Sorry.
It's sort of what I was saying, right?
Go ahead, Alex. What was that?
It is a little bit like what Lev was saying with the Brownian motion, right? Where you have some drift and some volatility, and then you estimate what different holders or different CDP owners would expect to gain or lose in those situations. Except you can get knocked out if the thing drops below, to Vishesh's point. So. Okay, and Lev, you have.
I think what Mateo's asking is you can look at an options market, and if you have some model of options pricing, maybe it's Black Scholes, then you can look at the prices of options on a market and then use that to reverse engineer what the implied volatility is, which is a nice way of, it's like, if you ever heard of the VIX or something for equities, that's like an index of volatility, and that's reverse engineered from looking at an options market. My only concern there is that you need a good, efficient and liquid options market in order to be able to refer to this. It would be really cool if there was one for crypto. I'm not aware of anything. I know that they exist, but I don't know if there's like an industry standard one that people trust.
Sorry, is this related to the current conversation or the previous one we were just having?
The previous one.
The previous one. Got it. Deribit does support ETH right now, actually, Matteo. And I think there's just very mediocre liquidity from what I've heard.
Okay, well, maybe I have a question about some of those things that you listed off, Cyrus. And one of the ones that I'm particularly hung up on, or at least most interested in, is the inventory level problem, and how we can acquire those numbers in a way that's trustworthy without jeopardizing people's business positions, and doing it in a way that benefits the group as opposed to like I said, releasing business intelligence. So do we have a plan, or are there ideas about how we can approach different market makers and get those numbers and have them report them, or is it going to be sort of on a voluntary basis?
Yeah, there's a
Rich,
few.
Sorry.
No, go ahead, Love.
I don't know if this has already been brought up in this call. Rich, I know that I've shared this idea with you, and Cyrus, I've talked to you about it as well, but if we go into this crypto economic limit where technology allows us to do really cool things, then it's possible for a bunch of market makers on this call to provide zero knowledge proofs about certain pieces of information about their inventories without saying that that's my address, or this is exactly how much I have, and so on. And I actually have this is more than a pipe dream. So I've spoken to some researchers on this who believe that not only is this something that is possible with the zero knowledge primitives that have been implemented on Ethereum, but moreover, even from a UX point of view, this is something that might actually be not so far off. So I'm just floating this as like if there's sufficient interest for someone to want to take the lead on this kind of thing, it's something that I think would really kind of benefit this governance discussion in the long run. I think a lot of people would be disinhibited when talking about this thing if they had like a way of putting their money where their mouths are, but without just going onto this public call, and it's just potentially not worth it for many. So that's why I was proposing that.
Yeah, I agree, and I think that this is something that maybe MakerDAO would be happy to put into the commons, so we can sweeten the pot here. We have a granting program. There's a long tail of utility, excuse me, on the type of mechanisms that would allow that to happen for the rest of the ecosystem as well. So if anybody is listening, and or Lev, if you have connections, continue to pursue them, please, and let them know that there are resources available to help make that happen.
I mean, Lev, how would you trade off that idea against just using chain analysis to identify balances but not reveal identities? Because in that sense, you could even target balances from people that, I mean, it's just an idea, but you could just basically try to get all the market makers, whether or not they opt into this zero knowledge proof, and potentially get a more accurate estimate of what the inventory levels are.
Yeah, no, I think you can absolutely try to look on chain just without anyone's like permission, just to look on chain and decide that, oh, this looks like it's a market maker and their inventory is such, and therefore whatever. That's like a kind of parallel thing that you can do. Like, I'm sure at some point someone's going to come to this call with some kind of a bunch of like addresses and some crazy theory about what that means. I've certainly speculated about that kind of stuff. I'm just talking about like a different thing, which kind of has a different meaning in governance, which isn't like, oh, look, I found some stuff somewhere, and it looks like this is this is an exchange wallet, and it's got loads of DAI in it, and that means that something retail users, blah blah blah, or like this looks like a market maker because of the number of transactions that's coming out of their account and whatever. I'm kind of talking about a different thing, which may be less or more valuable, I don't know, but it's like someone being able to back up what they're saying with their proof that they're honest, which I think has a different role. I don't know, to be honest. Like I think it would be a good start probably to start with something that doesn't require any opt-in, like you said. If someone wanted to work on that from that perspective, I think that should be encouraged. But in some cases, I think that's not going to give you enough information. Like obviously, you can get so much more detail from someone telling you about what they have, and then also providing a cryptographic proof of it, right? Then, for example, how much, what kind of serious governance decisions could we really make based on like some speculation about some paper trail on the blockchain that you don't actually, you could have just been completely wrong. Like you could have completely misjudged it.
Yeah, I mean, at the same time, though, there's also, there's concerns, I guess, on all sides, because in the other scheme, you could have market makers deliberately under-reporting what they have for whatever reason, if they had some incentive to do so, right?
Absolutely. So any proof like that, you would interpret it as I have at least this much, rather than I have it exactly that much or at least that much. Yeah.
So do you think we should explore both options and potentially others as well, if there are other things we can come up with?
Yeah, that's what I'm saying. I think these are kind of different things, but it would just be kind of neat, right? Because there might be like a bunch of market makers that are sitting here and they're like, I would really like to be able to attest to this fact, but I don't really want to go on to YouTube and say it. But if they teamed up, they can basically get a substantial anonymity set between them, and then share the stuff that they want with proof.
Okay, cool. Let's discuss this offline again then.
Yeah. You can get a real good sense of where the market makers are by looking at things like the GDAX, USDC, DAI market. You can see there's been over 1 million sitting at $1 for months now, and we haven't hit that yet. We haven't eaten any of that yet, but we are starting to see some larger bids in the 96-cent area, which is good, which we haven't seen until the last couple of weeks. So just looking at the markets themselves will tell you something about whether things are going in the right direction, and they are going in the right direction right now, fortunately.
Yeah, I've noticed the improved buy side liquidity on Coinbase as well. A lot more bids stacked up. And incidentally, that is something that we can start to capture and monitor. Although I think that's a little bit less of a priority compared to some of the other things we're trying to do right now.
On the subject of the DAI USDC market on Coinbase, I think that Coinbase's users need to complain that Coinbase needs to have a separate pricing scheme for stablecoin to fiat markets, because I just think it doesn't make sense to have the same commissions. Like, I think that's seriously hamstrung this market.
All right. Well, we're getting close to the top of the hour. We've had some good luck previously with continuing the call afterwards. So if anybody's interested in hanging out and just getting nerdy with money, please do so. Stephen, did you want to wrap things up for us, and so we can let you go?
Yeah, I don't know what I can add to this discussion today, because it actually has stepped up in quality. Thank you very much for all those that have contributed and really taken this to the next level, where we can start talking about very practical solutions to the challenges. But other than that, I've got nothing further to add. Just a sound of appreciation, and thanks once again for joining us on this call. And that's it.
Yeah, I agree completely. This is the picture of, this was my dream for what governance calls would be all about. So thank you everybody for making my dreams come true. Thanks for all the questions. Thanks for all the graphs. If people need to leave and you still have questions, please continue to ask those questions in the link to the discussion thread on Reddit. We'll be posting the videos, the audio, and the transcripts to that thread. We'll also be continuing the discussion over the course of the next week. So if there's burning questions or things that still need to be talked about, please do it there. Otherwise, I'm willing to hang out for the next half hour and just take some random questions if it turns out that there's enough interest. If not, we'll put this thing to bed. All right, thanks, Stephen. Thanks, everyone, for coming.
Thank you.
Thank you, everybody.
All right, well, that does sort of wreck the flow, but it also lets people with hard stops get out of the call in a way that makes sense. So, Lonray, if you are still around and in a position to use your microphone, you had an interesting question a while ago that sort of got buried about fixed term and variable term loans. If you wanted to ask that, it might be an interesting question to talk about. Is he still on the call? I know we lost him, so maybe I'll ask it. It's something that we've talked about a few times, well, more than a few times in the past, but every once in a while, it's good to revisit some old territory. So Lonray asked, as a general question, what was the intuition behind not giving DAI loans predetermined expiration rates? Is the case for most other derivatives, most arguments around why DAI should be around $1 rely on arbitrage arguments wherein CDP holders can arb against the system. If the DAI had expiration terms of 6 months, this would open up ARB to everyone. So, Cyrus, maybe can you comment on, this is probably long before your time, but maybe you can comment on some of the thinking behind variable and fixed term loans.
I mean, don't know what the intuition was, but just thinking about it right now, well, I mean, the no-term CDPs definitely offer much greater flexibility. So I think you could kind of implement the fixed term loans as kind of a subset. So it's something that could be built on top through some other service, for example. Not sure it makes sense, because if you have a fixed term, couldn't you just, when your term is up, you just pay off your loan and then just immediately open it back up again? And it would just kind of cause this unnecessary friction for the end user without any real lasting benefit to MakerDAO.
Could I just jump in? doing a fixed term, the idea would be you get a fixed stability rate. So you get a fixed stability rate for your term.
Right.
So
Yeah.
when it closes, you open up a new one. You're at the new market rate.
Yeah, but we're moving into fee swaps at that point, though.
Yeah, I don't think that wasn't my interpretation of the original question.
I think to answer this question, you need to actually first figure out what exactly it would entail, because as Cyrus pointed out, if the fee is still floating, then it's just a weird friction. If the fee is fixed, then it is economically different. And if you think about it for a little bit, you realize that, well, I can't say whether it's good or bad, but it does make the system quite complicated, because you then have this like stickiness in the yield curve. You get this additional complexity from the fact that the CDPs are not fungible anymore, because it depends like when they were created and when they expire, right? So then you have a market for these CDPs, because if rates go up, I don't want to hold the CDP anymore. I might actually want to. They become kind of like bonds, right? So there's like this whole like zoo of different CDPs, because the CDP that I open today isn't going to be the same as the CDP that I buy from someone who opened it 6 months ago. So you have to imagine that this becomes like a more definitely, in my opinion, a more complicated system, even though it might be good. As Rich alluded, like there are ways that you could build this on top of a floating fee system with swaps and kinds of derivatives.
Right. Is it variable no term loan kind of the most generalized form of loan that you could have, and then anything else is just a subset?
Yeah, that's what I think. So I think it kind of that seems like somehow it should be possible to build that as a special case on top of Maker.
Andrew, you had an interesting question. Do you have access to a microphone to ask that, or do you want us to read it up?
Yeah, no, I definitely got a mic. Multi-collateral DAI is on the horizon, and it seems that a natural progression there is that since you don't get to put multiple collateral types into a single CDP, I would open up a number of CDPs across my collateral types, and then I'm pretty diversified in terms of my risk across the board. But if I sent all those CDPs to a single point of ownership, like a set protocol token or something, or an actual basket of CDPs, then I'm kind of creating an index. And so if this becomes a more popular way to hold and manage your CDPs, you could start, in theory, funneling into an application that consistently refunds or your CDPs across your different hedge positions to maintain your index at a certain thing. If this becomes a more popular thing or an indication of where the market would go, would this become a first-party offering through Maker?
So is the question that if there's a popular index like a basket of like S&P basket, could that token that represents a basket be a collateral type?
Yeah, in one regard, but perhaps like the idea of building an index CDP natively inside the platform, rather than me as a user, personally collecting my CDPs together and then bundling them. The idea of bundling into like an index CDP as a part of the platform itself. And the S&P is a really good example. So if you had an S&P token and that became a collateral type for an actual CDP, could you take out leverage against these underlying synthetic assets? And then just the concept of bundling CDPs. If I have a number of different CDPs I've taken out, and so ETH is a good example. If you got different collateral types or collateral ratios, you could look at even though I have all ETH for my collateral types, I'm going to have 3 different types of CDPs open, maybe one that's got a safer buffer on it than other ones. And how can I better manage and maintain those? Because if I can imagine, if I get into the realm of 10 to 20 CDPs, it's going to be quite cumbersome to manage.
Right,
from
but
that side of things.
Is an end user really going to be leveraging off of 10 to 20 different assets?
Well, there's another thing also to consider, Cyrus, is that even if they are, like the CDP dashboard that's for Maker, it's constantly going to be iterated. So you might not actually need to bundle them. They could be bundled in the interface. I mean, if your wallet owns all of these CDPs, you might just have a really comfortable interface to work with. So you don't necessarily have to do it on the on-chain level. That's my kind of intuition.
Yeah, could just be a UX abstraction.
Andrew, so I think I get where you're coming from. Actually, there's been this notion floating around for a while that the fact that an MCD a CDP only contains one asset, and when setting risk parameters, the governance can't discount for diversification. In the real world, this is super practical, because if you went to your broker and you bought one stock, like let's say you wanted to get leveraged on Tesla, they would extend margin to you, but their liquidation ratio, well, that's not what they call it, but the equivalent would be pretty high. So you wouldn't be able to get more than, I think, probably something like 2x or well, in a 2 to 3 to maybe 5x leverage on a single stock if you were lucky. But if you came to a broker with a portfolio of stocks, like let's say 20 stocks, 20 names from different industries, you wouldn't have trouble getting 20x, 30x leverage on a portfolio margin basis. And that's because if you have 20 stocks from different sectors, there's just no way that that portfolio could drop like 20% in an instant. And that really affects how people get margin, because almost everyone is getting margin on a portfolio basis, because a single line margin like a CDP is actually just too constraining. I mean, I guess maybe futures traders work differently, actually. So that's an interesting comparison there. But the point is, there is definitely value to what you're saying, and it would need to happen probably at the smart contract level, because you need to give governance a way of expressing this view that they are willing to discount for diversification. There, if we had hopefully one day 20 different collateral assets which weren't super correlated, you would actually want to say that the liquidation ratio on this should be really really low, and the stability fee this should be pretty low, and so on. So I think what you're saying is really reasonable, and I do think actually that for some of these use cases you need this to be at the contract level.
Cool, thanks. Yeah, I see a lot of just like I guess my side of things is, I don't have a deep financial background in terms of traditional assets, but as a programmer and start collecting and playing with these things, like the management side of things, being able to bundle them and then be able to treat things as a bundle, you could see that like it would allow you to heavily diversify risk in terms of getting liquidated and managing that side of things. And then in terms of like repaying debt, you could start looking at repaying some sections of what your collateral types debt are to offset your overall risk preference that you have against your CDP or your outstanding debt, rather than being forced into potentially giving up an asset that you need the utility or the value on or the liquidity of today. But I have a basket of other assets I can pull from to overall manage that risk level.
There's another question here that I think is kind of interesting, and it's not as cool or as complex as Lev's observations. But what if set protocol, some kind of a bundling token, was considered as an asset class? Is that conceivable, Cyrus, from your framework?
I think so. As long as
risks associated with it.
Yeah, I mean, as long as you can break it down into what the underlying individual assets are. And so, for example, if you have Apple stock and then you have, S&P token that has some Apple stock in it, as long as you kind of are careful to not double count and increase your exposure.
Let's use SET as an example, because SET just lets you arbitrarily collect shitcoins together.
I don't think that would be possible, because it's just way too much governance overhead. So if there's like a super popular kind of few of them, that makes sense. So maybe like a general crypto basket that's like kind of agreed on could be cool.
Top 20 coin or something.
Yeah, something like that. Then I think that might make sense.
Interesting.
Yeah, that's where I kind of got the idea of, Coinbase does this index, and at Groundhog, we're about reoccurring payments. And so, as we expand our different offerings that we have for reoccurring payment supported assets, we focus heavily on ETH and DAI right now with Wrap Bitcoin once good price feeds for it come out. But as we start to take transactions, we'll start to get a better understanding of where commerce is happening on our platform, but where, ultimately those tokens are going. And that itself kind of creates a signal, like a commerce index. And so in theory, if you wanted to just hold an index or hold a basket of tokens that are heavily valued in a commerce space. That gives you kind of like a, almost like a bottom floor hedge against potential market movements. And so I could just like, that's where the head kind of, or the thought kind of came around bundling assets and how you could use that in a CDP.
So I imagine that like some set protocol tokens, there might be like standards that a lot of people like to use. So you'll see like a natural emergence of like the most comfortable sort of sets.
Yeah, I think so.
I wanted to point something out that was mentioned at the beginning of the call about how great it is that there's, and people have been saying this recently, that it's really great that there's stuff like Compound and Dharma, like the secondary lending markets. There's like a more formal way to look at the symbiosis between Maker and the secondary lending markets, which is that comparing kind of in the real economy, lending is done by a bank, and then lending that's done kind of by the market, like when the company issues a bond, for example, or gets borrows in some other way. I think that this is a worthwhile analogy, because when a bank makes, if a company gets a loan from a bank, then when they get that loan, essentially M1, like the broad money supply, is expanded. Presumably, there's some level of M1, which is kind of the right amount for a certain economy, which is like the amount of cash that not cash, but the amount of money that you need to have in circulation. And some lending expands M1, and some lending doesn't expand M1. And both central banks and bank regulators try to exert some influence on this. But presumably, kind of you could compare this to our situation with a weak DAI, which is that if DAI is below our target, then it means that M1 has gotten too big, and we need to try to do more lending without expanding M1, and that is precisely people lending DAI through Dharma or Compound instead of creating it in Maker, and us adjusting the stability fee or other risk parameters is like a central bank doing monetary policy or enacting some regulation on deposit or reserve requirements and this kind of thing to affect M1. It's kind of turning the question on its head, because it's not, I don't think it's really how central bankers think, but it's just interesting to make this comparison that some lending increases the money supply and some doesn't. And they're qualitatively different.
Yeah, that's a meme that we've been trying to extinguish for a while. Lev, do you have any observations about why people aren't simply converting their fiat to DAI and then taking advantage of some of the interest rates that we're seeing in the secondary lending market?
Sorry, what's the meme that you're trying to extinguish? I didn't follow.
Sorry, I might have been too slow on unmuting myself. No, I was thanking you for talking about the distinction between these, the lockup on DAI through the secondary markets, and whether that actually impacts the demand or the supply that we have laying around. But the second question that I had for you, though, is, and I always caution that I'm a financial neophyte, so maybe I'm missing something, but we have places like Compound and Lever and Nuo and this whole host of these secondary lending platforms that are very interested in lending out DAI. And from my uneducated perspective, it seems like the average person would go, well, I'm just going to buy I convert my fiat to DAI and collect 10% off of Lever or what have you. Do you have any insight into why that hasn't been a more attractive option for the open market right now?
I guess that's the $100 million question, isn't it?
Yeah, I just wonder.
I don't know. The market needs to decide what the appropriate rate is, right? So, who's to say that the rate that we have now or we had a month ago was the perfect one, right? So, you can get very detailed with the answers here. I think certainly like perceived risk, how people imagine like global settlement going and this kind of thing, all should factor into it, or it should if you're, in the position of having to make this decision. But yeah, I mean,
sure.
I don't
didn't mean
broadly.
I'm just looking for guesses and not
so
science.
Rich, can I just take a stab at that question?
Sure.
So essentially, I mean, I think there's a couple things going on. One, people who like, there's a subset of people who are familiar with crypto, understand DAI, understand these systems, can get access to these assets. So we're already filtering down a fair amount. And I think like one big effect is once you filter down to that set of people, I think a big portion of those people are spending their capital on actually like buying ETH and Bitcoin and going effectively long on these assets, leveraged or otherwise.
So it's this vanishingly smaller Venn diagram as we get into the
yeah, and the other effect I think is like it's a 5%-ish spread right now for me to lend on Compound. It used to be higher. It also used to be lower. It's variable, but and I've tried lending on Dharma too. Like you get some smaller loans that people will take, but like significant volume for me to go and take $1,000, $2,000, buy DAI and go lend it on Dharma. It's a lot of friction and transaction cost, as has been mentioned on here, to get access to that yield if people are willing to take me up on that. And then, so I think like one, those frictions and those transaction costs, two, the kind of capital opportunity cost of what people want to do, what crypto people want to do with their money. And then three, like, I think it's a very real concern. Like there is this spectrum, as I mentioned, of kind of bullish and bearishness. In the middle of that spectrum, like there's a very fine line of people who are neutral and would, like, I would personally be the type of person that would buy DAI and then lend it out because I'm kind of neutral, but I still want to get some yield. But there is, like, in addition to those transaction costs, kind of this uncertainty or this volatility of like, okay, well, DAI price could drop, so I could take a haircut once I'm done lending and then I go to clear my DAI out. Or the potential just uncertainty of that yield might not make it worth it to kind of go through all those steps for just a 5%, where maybe let's say my personal cost of capital, which varies based on my risk tolerance, is more than 5%, and maybe there's something else that I could be doing for higher yield with dollars, which in fact there is. And so like I think the combination of those kind of three tiers of filtering down is what results in not enough people taking advantage of that arbitrage opportunity to just buy up the cheap DAI and then go lend it out.
That's good insight. Cool. Thanks.
Does that suggest anything for what'll happen when the DSR is live? Like, will there be enough demand to actually do lockups?
I think the DSR is different from secondary lending, and I'm sure Lev will jump on that point too, but I think it's a different type of yield and a different type of lockup, and has different effects on supply and demand. I know a lot of people have been talking about secondary lending and the DSR differently, but like my general sentiment is that the DSR will be an important kind of leg to the system and will legitimately improve both the DAI price and kind of the opportunities for yield.
Yeah, predictably, yeah, I agree with what you're saying. I do think they're different. So like the secondary lending actually is very significant economically, and then the DSR is going to be a useful policy tool, but that's not satisfying anyone's need for credit because you're not actually lending to anyone, right? So it's comparable to the interest rate that the Federal Reserve pays on deposits, which is like it's kind of made up because you're not actually lending to anyone. You're not financing any useful activity. It's just a lever that they have that they can coax things into doing what they want. And for us, it's the same. So somehow it's much more interesting to think about secondary lending than DSR actually, because when you think about it, DSR is kind of just imaginary, right? Like it's how economically significant could it be that that the smart contract is just minting DAI without, it's not actually financing any productive activity, right?
The other thing to note about secondary lending is that, if there's a yield to be chased and there's, people locking up, I don't know, 3 million, whatever, DAI in Compound to try to get that yield. But if the borrow amount is significantly lower and not all those people are being taken up on those loans, then that's actually just kind of locked up capital that's effectively just pulling DAI out of circulation. And I think that's another interesting effect to look at for some of these lending platforms, particularly kind of like the pooled lending, kind of like Compound and a little bit Uniswap. where it's effectively just dye that's sitting out of circulation. Now, it's really hard to say how long it would sit out of circulation for, but if it's not being borrowed and then sold back onto the market, it is effectively being pulled out of circulation, and I think helping to pull up the dye price.
So this is one of the reasons that I was sort of thinking that fixed term and fixed rate CDPs would be interesting, is that stability fee could be set at, whatever, 10% or something like that. But if compound's lending out at 13%, then you get that. You could draw from your CDP, put it in compound, and because you have a fixed rate, you get that secondary lending market. Does that, would that sort of simulate something like the DSR, or is it again totally different?
Who wants to pick this one up? Because I'm not capable of doing it. Cyrus or Lev?
Sorry, can you repeat the question? I got lost for a second.
Sorry. So we were talking about fixed rate and fixed term CDPs earlier, just as a theory, or what the different behaviors would be. So to encourage a secondary market. So if you have a fixed rate of, say, 10% in this case, and you're going to get that for a year, it means you can take that dye and lend it out at any higher rate that you find in the secondary market at 13%, 14%, 15%. And that can also help, suck up demand, potentially, kind of like a DSR. Does it have a similar behavior to the DSR?
To be clear, what you're talking about is taking dye out of a CDP and then lending it?
Yeah, I think that's what he's saying.
Yeah, that's exactly what it is. Obviously not in the system that we have today, but if fixed term and fixed rate CDPs ever exist.
Yes, but if you did this today, you'd be sitting with this like very big rates exposure.
Right.
Maybe you could find a way of insuring against that. I don't have any other answer other than like that's an interesting universe to think about.
So you were talking about your M1 type money supply, where a central bank would have a certain rate, but they typically keep those rates quite low because what they're encouraging is a secondary market everywhere else. The central bank doesn't need to make profit, right? Maker holders are interested in making profit. So we're a little different in that respect. So if you're trying to encourage,
I didn't actually follow. Which rate are you comparing maker holder setting to the central bank setting explicitly?
Maker holders are, I don't think they're quite the same as a central bank. Central bank can print money whenever it wants. DAI has to be collateralized, backed all the time. So MKR holders are not really this. They don't have quite the same incentives. They are seeking a profit on their capital. Maker holders.
Oh yeah, for sure. So I wasn't trying to say that they're the same in every way. It was more that I think there's some interesting analogies in how some of these policy instruments work. But yeah, sure.
Lev, I have a question for you. If the DSR was live today, how would you determine whether the DAI weakness needs to be solved by increasing risk premium on the collateral due to the demand of leveraging off that collateral versus some sort of general weakness that needs to be fixed through the DSR? Because discussing this last few days, if you have like 10 collateral assets, it doesn't make sense to unfairly punish other collateral types that are appropriately risk managed, appropriate supply and demand, and then one collateral type all of a sudden shoots off, right?
Yeah, I'm glad you asked. Actually, I'm not sure if Primosh is here, but
he's not.
A discussion that we had. Oh, okay. A discussion that we had a couple of weeks ago kind of changed my mind on this question, or rather, now I'm more confused about it. But he brought to my attention that this, that you can't just view. Basically, we were trying to compartmentalize things by saying that when we're talking about the DAI price, we're talking about monetary policy and stability. And when we're talking about collateral risk premia, we're just talking about collateral risk assessment, and these things we can kind of treat as two separate parts. But as he pointed out to me, it's really not the case, because there's one perspective on what's going on with credit demand, which is that it firstly is idiosyncratic to a collateral type, so it's not like credit demand across the whole portfolio will be moving in tandem. And secondly, there's a way that you can think of this question as being actually nothing to do with like not from the perspective of monetary policy, but you can just think about it from the perspective of risk premia. And if the market is like pricing in more higher risk and higher return for an asset, that means that people will want to leverage it. People will be comfortable paying a higher rate for credit against this. But that also means that the flip side of the coin is that governance has to charge a higher stability fee for it, because they're taking more risk. Because this if the expected return on this asset has gone up, then presumably the expected risk of this asset has also gone up. And this part, it gets a little bit sketchy, because you have to think about what specifically MKR holders are, what risk they're taking, because they're not just taking a symmetric bet with the borrower on the asset, right? Because they're only really on the hook if you have liquidations that don't recover. And that's like that's very much a tail risk. I mean, to this day, there has never been a liquidation in the system that hasn't recovered the full value of the debt. So this is like the black swan of black swans for us, because the day that we see that, it's going to forever change our understanding of the world, because it's so. So from that point of view, it actually becomes a little bit hard to say what is the if you take some basic model of an asset's risk and return having increased, and therefore people tolerating a higher stability fee, what is the effect of that on the tail risk that MKR holders carry? And that's like almost impossible to formally calculate, because you certainly don't want to just take some you don't want to take some normal distribution or something for tail risk, because then you're clearly kind of black swan foolish. So it's so basically the answer is I don't know, but it's like it just turns out this is actually a really serious problem.
Right. So the way I was thinking about it was, I don't think that it's the expected return of the asset that they're buying with the DAI that's necessarily the factor here, because for all we know, they would be doing the exact same thing if it was Bitcoin, right? They would lever up on ETH like crazy to buy Bitcoin if it was easily purchased through DEXs or whatever. But if you have so there's a risk premium for the risk of the asset failing or whatever, kind of the standard collateral risk. But then it appears that there needs to be a debt ceiling related adjustment, like a debt ceiling related DSR specific to the collateral as well, because as a lot of credit or leverage is built off of one collateral, it's not that the market cannot just arbitrarily facilitate this extra demand for credit, and there needs to be an adjustment made based on the debt ceiling, is how I'm seeing it, right?
So you're saying basically apportioning the DSR deltas across the different collateral types not equally as we do now, but like the one that has a higher debt ceiling gets more of it, and so on.
Well, I was actually even thinking maybe like a general one because I was thinking even if you factor in that collateral specific DSR adjustment, there could still be a scenario where you're not, even if everything is perfect, you're not quite at equilibrium due to the compositional differences between DAI and USD. Just whatever innate factors that make them separate needs to maybe there may be a gap that exists that needs to be filled by a system-wide DSR. But then also these many individual DSRs as well.
Yeah, I guess what I'm saying is maybe it shouldn't be viewed as the DSR at all. So somehow maybe the credit the credit risk premium need to be also very carefully following this conversation, and they need to check to what extent is the expanding credit demand happening due to the fact that they've mispriced the stability fee, but from a credit risk point of view. But do you see what I'm saying?
Yeah, but that doesn't make sense, because a user would have like a surge of demand for leverage off of ETH, not because they think ETH is going to go up because, as I said, they could take that DAI and buy Bitcoin with it. But rather, this surge of leverage comes from the expectation that ETH won't suddenly crash to a liquidation point. It's like basically safe to lever off of without getting liquidated because they perceive ETH to be in a rising market.
I agree with you, but would you agree that also there, especially in like a multi-collateral world, there's a correlation between the assets that people are buying with their credit and then the assets that are going in the collateral portfolio? Because it's pretty natural that if I want to buy some whatever Bitcoins with my credit, then I should really also be using those as collateral. So I think that there's probably, but I take your point, which is why I find this whole question kind of confusing, because it could be completely the case that people are levering Ether so they can buy, U.S. Treasuries or something completely unrelated.
Right.
But there, you can do a thought experiment, which is like, suppose you're in a market where, suppose like basically what happens. So DAI was stable with a stability fee of 50 basis points, and then later DAI is, somehow still struggling to keep up with a stability fee of 20% or something. Something has changed in that world. And wouldn't you agree that there's at least some chance that the thing that's changed is the risk premium associated with the collateral? I'm not saying that it's the only thing, and I don't think it's like a simple model where one thing just drives the other, but like it could be that this is an indicator that
wouldn't the risk premium diminish as ETH is perceived to be healthier and less chance of failure? Versus think about MakerDAO offering loans on ETH in December when it looked like it was going to crash to zero any second. There's significantly more tail risk there, and the stability fee was 0.5%. Now there's,
well, I guess I'm assuming this like efficient markets thing, which is that ETH should always have the same Sharpe ratio, which isn't really. But just you see at least where I'm coming from, which is that you shouldn't have. Well, in some sense, you shouldn't have that. Like if people think that ETH is going to go up, then that should be reflected in the market's expectation of the risk reward. So if they think the risk is lower, then the return should be lower. It's kind of weird if at two different points in time you had ETH was very low return but high risk, and then another time it was high return low risk, because then there's some kind of dislocation.
Right. So what explains that dislocation?
Well, maybe that there isn't one. Maybe Ether's kind of risk and return move in tandem to some extent is I guess what I'm saying.
But okay, but the risk of ETH to an investor, but see that risk reward to an investor is just like if they have full upside downside exposure. The risk to MakerDAO is not follow that Sharpe because we don't have that upside exposure.
So that's what makes this kind of screwy, is because you have to see how this from an investor perspective risk return gets reflected on Maker's risk assessment, which is all about tail risk, which isn't trivial to decide how it reflects.
So actually, it seems to me that the mistake.
I feel like maybe it'd be interesting to bring Primosh into this discussion, because he had this strong opinion about this risk return being coupled thing, and he kind of opened my eyes to this being a possibility.
Sure. Yeah, maybe we can talk about this next week on the call.
Yeah, I was just going to say, this feels like a great topic, so let's make sure we don't lose this conversation.
Well, it's recorded.
The other quirk about having multiple savings rates is where do those savings rates end up going? Do you get like colored coin DAI, one per collateral type that gets a different DSR, so you lock up what got inflated or is oversupplied, or does it just go to any DAI?
Yeah, I think that the standard DSR is just a general DAI. I mean, the collateral specific adjustment I was talking about was not actually a way for people to put their DAI somewhere, but rather what kind of additional premium needs to be charged on a collateral that's causing the peg to drift.
Yeah, so we should be clear here that DAI has to remain fungible, and so any DSR would end up being a blended DSR after taking all the individual collateral types into account, right?
Right, but then the point of the DSR is if you have a 5% rate on, you know, because DAI is always 1-to-1, always printed and loaned out at that, you know, a finite number. You never have more people taking CDPs than you have DAI in existence. So if you take a 5% rate from CDP owners, that gets paid 5% to DAI owners.
Yeah, but that's only DAI owners who have it locked in the contract. Not all DAI holders get the DSR.
Oh, okay. I didn't know that. I
Yeah,
thought it was all DAI holders.
Yeah, no, the equation is just the DAI holders who lock it in that contract.
All right, we're at the hour-and-a-half mark, and this was a good conversation, but I'm concerned about the likelihood of anybody watching a 2-hour governance call. If there's other super pressing questions or conversations to be had, it looks, according to the chat, it looks like there's going to be a lot of people breaking off into individual discussions, which I'm super happy about. If there are questions that didn't get addressed in the call, please, I'm begging you at this point, go to Reddit and continue the discussion in the MakerGov thread. But I have a hard stop, so I need to bounce out, and that means I need to stop recording. So thanks, everyone, for joining. Thanks, Lev, for your deep insights. That was hyper valuable. Let me know what your rates are, because I want you back in the next call as well. So thanks, everyone.
Yeah, great call, everybody. Take care.
Bye.